In every market cycle, the same thing happens. Prices rise, confidence grows, people believe this time is different, and then suddenly, the market drops. Panic spreads. Headlines scream recession. Investors sell at the worst possible moment. But while most people panic, Warren Buffett does the opposite. In fact, market crashes are where he has made some of his biggest fortunes. So the real question is, if a crash happens in 2026, will you panic like the crowd or invest like Buffett? Today, we're breaking down the 5 rules Warren Buffett follows to survive and win during market crashes. Rule number 1, don't predict, prepare. Most investors spend their time trying to predict when the next crash will happen. Buffett doesn't. He has famously said, "We don't have to be smarter than the rest. We have to be more disciplined." Here's what that means. Nobody can consistently predict market crashes. Not economists, not hedge funds, not YouTubers. Instead of predicting, Buffett prepares. He keeps strong businesses, healthy cash reserves, long-term conviction. When the 2008 financial crisis hit, most investors were terrified, but Buffett had cash ready. And while others were selling, he was buying. Preparation beats prediction every time. If you're constantly asking, when will the crash happen? You're asking the wrong question. The right question is, if it happens tomorrow, am I ready? Rule number 2, only own what you understand. During crashes, confusion spreads fast. Investors suddenly realize they don't understand what they own. Buffett avoids this problem completely. He only invests in businesses he deeply understands. For example, he invested heavily in Coca-Cola, Apple, American Express, simple business models, strong brands, consistent demand. If you can't explain how a company makes money in one sentence, you probably shouldn't own it during a crash. Because when prices fall 30%, 40%, 50%, your conviction will be tested, and conviction only comes from understanding. Rule number 3, volatility is not risk. This might be Buffett's most misunderstood principle. He does not believe volatility equals risk. The media tells you markets are risky because they move up and down. Buffett believes risk is buying something you don't understand or paying too much for it. In fact, when prices drop and fundamentals stay strong, risk can actually decrease. Imagine a great company selling at a discount. Is that dangerous or is that opportunity? In 2008, he invested billions into companies when fear was at its peak. Why? Because volatility created discounts. If you see red numbers and think danger, you'll sell low. If you see red numbers and think discount, you'll build wealth. Rule number 4, cash is power. During crashes, Buffett always keeps cash available, not because he fears the market, but because he wants optionality. Cash gives you flexibility, speed opportunity. When others are forced to sell, you can buy. This is why Buffett has often held large cash positions inside Berkshire Hathaway. Critics say he's missing gains. But when downturns hit, that cash becomes a weapon. If you are 100% invested with zero liquidity, a crash traps you. If you have reserves, a crash empowers you. Rule number 5, time in the market. Beats timing the market. This is where most investors fail. They try to sell before the crash, buy at the bottom, perfectly time recovery. Buffett doesn't play that game. He focuses on decades. Look at history. Markets crash, markets recover, markets grow. Every major downturn eventually looked small on a 20-year chart. Buffett's wealth didn't come from one perfect trade. It came from consistency, compounding, patience. If you're investing for retirement in 15 to 20 years, a one-year crash is noise. But panic selling? That's permanent damage. Emotional reinforcement. Let's go back to 2008. The S&P 500 dropped more than 50%. Fear was everywhere. But those who held quality companies and reinvested during the crash saw enormous gains over the next decade. Crashes transfer wealth from the impatient to the disciplined. Why most investors fail? The biggest threat during crashes isn't the economy, it's emotion. Humans are wired to avoid pain. When you see your portfolio down 30%, your brain says, "Get out." Buffett trains himself to think differently. He asks, has the long-term value changed? If not, why sell? Relevance boost. Today investors worry about inflation, AI bubbles, interest rates, recession fears, but these concerns exist in every era. Different headlines, same psychology. Buffett doesn't react to headlines, he reacts to value. If 2026 brings volatility, it will not be the first time, and it won't be the last. 3. Takeaway summary. If you remember nothing else, remember this. Don't predict crashes. Prepare for them. Only own businesses you understand deeply. Volatility creates opportunity for the patient. And most importantly, market crashes are not wealth destroyers. Panic is. If you want to invest with long-term discipline and think like a rational investor instead of a speculator, subscribe, because the next crash won't destroy the prepared. It will reward them. And the question is, which side will you be on?